Hello, this is June Collier, your corporate network marketer. In today's video, I will explain why wealthy people do not use banks to create their wealth. There are several investment options in the financial industry with varying degrees of risk versus reward. Many people believe the bank is the first place to go should you want to save your money and start investing and create wealth. I'm going to explain to you why the bank is the last place the wealthy go to invest their money. Banks are in abundance all over the country, and chances are great that you have an account there. Banks offer one form of investments, which are known as cash equivalents. Cash equivalents come in the form of checking and savings accounts, certificates of deposit, also known as CDs, money market funds, saving bonds, and Treasury bills. A cash equivalent offers a low-risk, low-return profile. They are the most liquid assets that you can invest in and are convertible into cash very quickly. Savings accounts, money market holdings, certificate of deposits, short-term government bonds, or Treasury bills are all considered cash equivalents. Let's visit Bank of America and check out some of its cash equivalents. Under savings, we have a choice of 3 accounts. In order to qualify for 0.03%, we would need to deposit a minimum of $2,500. Otherwise, we would need to open the other savings account that provide a 0.01% return. Let's go back and take a look at the certificates of deposits. Again, there are 3 choices, and to get the maximum return of 0.07%, we would need to invest $10,000 and tie it up in this investment for a minimum of 12 months. Finally, let's take a look at our last option, which is a bank IRA. Now, before you get excited, an IRA is not a type of investment. It is simply the tax treatment on that investment. I will cover IRAs in a later video. Bank of America offers several different IRAs, but let's take a look at the highest percentage paying IRA, which is a standard term CD IRA that pays 0.03 to 0.15% on your money. This is the most percentage return that we've seen so far. Let's click through to see what we need to do in order to qualify for the 0.15%. If we scroll down towards the bottom of the page, we see that if we are willing to invest a minimum of $1,000 and tie it up for a minimum of 48 months, we can earn that 0.15%. Want to earn more? If you have $1 million, you can earn 0.20% in an analyzed business investment account, whatever that is. Now, let's take a look at what this really means. If you're going to invest your money, you want your money to grow, correct? In order to determine how fast your money will double, you will use a financial formula called the Rule of 72. Basically, divide the number 72 by the interest rate you will receive, and the answer will be the number of years it will take for your investment to double in value. So as you can see, at 0.02%, it would take you 3,600 years for your money to double. That's what your savings account is paying. At 0.15%, it would take 480 years to double. That's what the standard rate IRA is paying. By comparison, let's take a look at how much interest Bank of America would charge you if you borrowed money from them. Let's look at their 3 most popular credit cards. As you can see, on the low end, you would be charged 10.99% interest, while on the high end, you are being charged 22.99%. Let's look at automobile loans. Their best rate for a new car is 2.49%. How about mortgage rates? Mortgage rates vary from 2.85% to 4.125%. Let's see how the bank fares out with its investment returns. When they loan money out for car loans at 2.49%, it takes approximately 28 years for their money to double. Loans for home mortgages take 17 years to double. And get this, most people are carrying a 30-year mortgage, which means they will pay twice for the real cost of their home. When they have people with good credit who use their credit cards, their money doubles every 6 years. And those with questionable credit, their money doubles every 3 years. So let me get this straight. You invest your money into a bank account, well, you will never see your money double in your lifetime, nor your children's children's lifetime. But yet the bank will give you a credit card and see their money double every 3 years. Do you now see why the wealthy do not use banks? Sure, a bank is good for keeping your working capital in, enough to pay your monthly bills and other immediate expenses. However, anything else, including your emergency fund, should be parked elsewhere. To learn about your options and how to make better money choices, contact me, June Collier,